This topic today is something that I've been waiting to do for months. I'm very passionate about this for reasons that I'll explain and that you'll kind of see as we go along. But the whole concept of digital risk, as opposed to just focusing on cybersecurity, is something that I have become more and more concerned about for the last few years. That digital risks are just going to grow. AI risk being the poster child right now, but there are other digital risks that are also growing, and there are ancillary risks to AI risk that we wouldn't call necessarily AI risk, but AI is enhancing those risks. And so I spend a lot of my time stepping back and kind of blurring my eyes and saying, okay, what's the big picture here that I need to be talking to people about? My whole mission in life is to try to be a blessing to organizations and help them see things that maybe they're not seeing right now about technology. I have to tell you, I probably spend 75% of my brain power these days in the AI world. But that other 25% is spent on this topic about what really are the digital risks that organizations need to care about. And so that's why this one's kind of titled A New Definition for Digital Risks, Enterprise Risk Management in the Intelligence Era. So I'm going to share some thoughts with you today. Some of these may not be surprising to you, and then there might be some thoughts that you find to be that are new. I'll tell you up front, probably remind you at the end. The big thing for me that I hope is that some of you will talk to your boards of directors and re-architect the way they are looking at digital risks or risks in general. Or talk to the leadership team and get the leadership team to adopt a more professional way, I don't know a better word, but a professional way of looking at what the digital risk portfolio is. And that's more than just one risk. Now, let me tell you what I'm not going to do today. I'm not going to give you a bunch of scary statistics about, look how much money this is costing or how many organizations are hit with this. I'm not going to tell you any specific stories from clients just in the last 6 months that I could tell you that have been nailed by some of these risks. So I'm not going to do any of that. What I do want you to do is just gain maybe a different perspective, or I'm hoping to sell you on a bit of a different perspective now about where digital risks are going to go and how can we better manage those. And again, the big reason for this is I do a lot of speaking to boards. I do a lot of work with executive teams. It's become very clear to me over the last year or so that they really are not managing digital risk as a portfolio. I did some research. I did a lot of research, by the way, before I put this together. And one of the things I researched is what firms in the United States are doing a good job at consulting with or helping organizations with digital risk. And basically the answers I got were the big four, right? So a Deloitte or an Accenture, they have big digital risk programs. But when I really dove into, okay, well, what is the list of risks that they are helping clients with? It was not a full portfolio in my mind. And that was one of the things that inspired me even more to have this discussion and to really work with clients for the next year or two to try to get them to improve. What is your full digital risk portfolio that should be managed, should be analyzed, should be risk rated? What should that look like? All right, so let's dive in and let's talk about some of the big basic things first. So as we become more dependent on digital tools, and we are, we've grown quite dependent on the data layer and the software layer. The data layer and software layer have been, under attack for the last 20 years from a cybersecurity standpoint, or insider theft or fraud, right? So those layers have become problematic from a digital attack standpoint. And now we have the new AI synthetic layer, right, that sits above the software layer. That synthetic intelligence layer means that we are doing all kinds of automations. We're going to be building all kinds of agents. We're going to be integrating all kinds of AI into the daily workload of, most of the people in the organization. All this is doing is amplifying the dependency that we have on digital tools. And there are three things already that I think are risks that are going to grow that concern me. One is just, I'll call it the contagion risk. As we become technically more integrated with customers, with partners, with vendors, as that ecosystem grows, and we are more and more working in cloud environments with less and less things on-prem, then there is a contagion risk, right? We have more risk from all these different organizations that we are connected to and depending on them for some aspect of what we do. And by the way, when I say more and more dependent on the cloud, there's interesting things going on with people moving back to on-prem for things like their AI compute. So it isn't like I think we're moving 100% to cloud, and I actually think the pendulum's going to swing back, and there will be more and more of, should we build digital capabilities that are on-prem, either for cost reasons or privacy or security reasons. But regardless, we are going to be connected or interconnected in an ecosystem, and that increases the risks. All right, this one we know, we have more and more attack vectors the wider we make our digital canvas. So the more digital plumbing that we are using, the more we are automating systems, the more we are providing tools that our people have to collaborate with to do their jobs, we create a larger and larger attack vector, a larger and larger body of technology that can be injured or taken over, and somebody can try to extort money or cause havoc. Same time that the attack vector gets bigger, the attack canvas, we have more and more digital criminals. And that isn't just threat actors from the outside. We have more and more people from the inside that are also a problem. And so this is only going to grow. And then finally, something that I don't think people think enough about, downtime is going to become more and more likely because there are less, I'll just say plan Bs. I don't want to say backups, because if I say backups, people think I mean literally backups. I mean, there are less plan B plans of how are we going to run a process where a lot of that process or all of that process was dependent on third parties to provide technology. Now, whether that's a SaaS provider, a cloud provider, right, or any type of third party that is playing a role in a process. If you're paying attention, you're probably seeing that we're having more and more kind of third-party risk, where third parties, maybe not even contracted to us, but third-party providers of our providers that are causing downtime. And then when the downtime happens, we do not have a backup. Now, I often think about, for example, when the car dealership software went out, 8 months ago, when it was out for 3 weeks under a cyber attack. And then there were car dealerships and farm implement organizations all over the country that could not do a transaction. And the reason they couldn't do a transaction is they had no paper backup. They just had no paper backup to be able to do that anymore. Well, there's all kinds of stories like this where a provider goes out and there is no backup. I think about banks. If your core provider goes out, you cannot do financial transactions at a branch anymore. It cannot be done because the branch is 100% dependent on the core provider and the technology to do a transaction. You can't even come in with a deposit slip and hand it to somebody because they can't even go verify the account, right? So anyway, our dependency is growing, and the consequences of that dependency are growing as well. So I think of what goes on now with digital risk mitigation as a tax on the organization. I just want you to think about that for just a second, right? To think about it as a tax. So if we go back in the Wayback Machine 30 years, a lot of the taxes that organizations are having to pay now because of their digital tools, you didn't have to pay. So you didn't have insurance for cybersecurity, right, 30 years ago. Like, there weren't costs that you had to incur to try to make sure that you were mitigating digital risks. Now, that's just trying to mitigate the risks. You also didn't have events happening that once the event happened, the taxes were higher. And so I think this is an important way if you're a technologist or you're a risk person. I know some of you that I just saw your names. I mean, I know we have we've got some CIOs on here that I respect. I think it's important that we start really looking financially at what is the tax that the organization is paying in order to be heavily digitally oriented. So as we become more and more hooked on digital, those taxes are going to go up. Well, what are those taxes? Like, how much are we paying in those taxes every year? So I really kind of thought about, well, what are the taxes that we generally pay for a risk? And then I'm going to apply this to just some random handful of risks and just show you a way to think about the taxes that organizations are paying. So the first one, preventative and/or insurance, and I'll show you some variations of this, okay? So preventative means how much money are we having to spend to prevent something bad from happening? Now, when I say like event insurance, I'm not just talking about cyber insurance. We can be talking about business interruption insurance, right? Which no one ever cares that much about until your business is seriously interrupted by a tornado or a fire or something like that. And so there's insurance that we have to buy. Well, that's a tax. There's a bunch of legal preparation sometimes that we have to do up front before a risk could ever be a problem. We got to pay those bills. We have staff that is dedicated in many cases to dealing with or stopping a potential digital risk. So we're paying that tax up front in labor. And then we spend money on employee education. That's both the money we literally spend to educate them and all the time they're taking to be educated, which is a tax. So in other words, there's a lot of tax that an organization pays just to be preventative from a digital event. Then you have the operational downtime. So some event happens, okay, or it's an operational issue, right? But something happens that now stops us from, being able to drive revenue. We can't sell for this week or this 2 weeks. We may have a work stoppage, right, which is expensive in many different ways. It could be that projects now get put to the side for 2 months, 3 months, while we're fighting one of our digital events that has happened. It could be that supply chain issues get nailed if you're a manufacturer, and that you might have some operational downtime which forces your supply chain to now be stopped, for a period of time. So again, lots of taxes that you get just from the operational downtime of some digital event. Then you have just the straight up event remediation costs. No surprise, right? We're back to lawyers and technology firms or security firms, consultants, people like us, right? Contractors that help do forensics or many things you might have to have a contractor do. And any other type of remediation costs to now clean up the mess from whatever it was that happened. So again, these are all taxes that you pay because of digital events. All right, this was, I'll tell you, just an interesting thing that happened about, I'd say 18 months ago. I get a call, and it's from a law firm in the Pacific Northwest. And there had been a cyber attack on a healthcare system, and they had a number of doctors who quit and left right after this cyber event. Well, the story went that it turned out it wasn't a real cyber event. It was a security firm that said that there was a cyber event when it turned out there actually wasn't. So a second firm was brought in, and it was proven that there never was a breach, right, of patient data. But the first security firm said that there was. So there was a big lawsuit filed by the healthcare organization against the first security firm. And I was asked if I would be an expert witness. And the reason I was asked to be an expert witness was the human toll. And they had heard that I had done a little bit of work of trying to study when there is a digital event, especially a cyber event, what is the human cost? And so I had to testify in this trial. So I will tell you what I said. Right? I said things like, well, when you have an event, a digital event, an outage or a cyber event, something like that, It's interesting, things you don't think about, like the salespeople didn't get commissions over the amount of that time. And salespeople get very ornery when they don't have an ability to sell, and so they can't make money. And so they were all demanding, right, in different clients we've seen that, hey, we get paid our commissions. It's not our fault that there was a digital event. We also found tons of stress and anxiety. Part of the reason the doctors had quit and left this healthcare system was just because of the stress or the anxiety that both their data might have been exposed or that they worked for a place that might have lost their patients' data, which, by the way, turned out that isn't what happened. But just the fear of that caused some of their top doctors to leave. All right, the overwork that can happen when you have an event. And so when you have an event, sometimes people get a part-time job. They still have to do their regular jobs, but then they also have to help deal with the event. And again, this event may not be a cyber event, might just be an outage. It could be a lot of different things. You got the market embarrassment, right, which we'll talk about next with the reputational damage. Sometimes there's guilt that is a problem. So we've seen, let's say, IT people that have allowed a insider event to happen because they never really thought about the fact that there could be an insider event that could happen. Or there's a fraud event that costs the organization a large amount of money, and the IT people didn't play the role they could have. A lot of times we see that they carry a lot of guilt for what didn't get done. And a lot of people don't think about this human toll as being a tax on the organization, but it is. All right, reputational damage, I think everybody would understand. Right, so a digital event, it can impact how a customer views you, or a patient, or members, right, or borrowers, right, whoever your customer is. There can be a bit of a loss of trust. And that can come from a number of different things, right? It could be you literally lost their data. It could be because they look at you as, hey, how could you have made this mistake? If you are a supplier to Walmart, if I give you an example, and you have an event, a digital event, that interrupts the data flow or interrupts anything with your relationship with Walmart, that's a serious issue for suppliers. Because in Walmart's view, they look at you as you don't have an ability to do risk management. Should they still do business with you? And this is real. I mean, this is just giving an example of one that I know. All right, competitors will take advantages. So once you've had a digital event, an outage, anything like that, competitors will now talk about that for the next 2 or 3 years. All right, you will sometimes give the impression that you are too small or unprofessional because you didn't manage your digital risks in the right way. And then, as I said, there's always the contagion risk that, hey, it could be your cloud provider that went out, but it's your customers that felt the damage from services not being supplied. And so your reputation gets besmirched, even though it wasn't technically your issue. It was a third party, but it was a third party you had no plan B for. All right, opportunity diversion. This is one we're starting to look at more and more. When there is some type of digital event, and it's all hands on deck to try to fix it. Again, I don't care if it's a tornado or what it is, then one of the things that happened is you cannot put energy into the innovative things or some of the other efforts you were doing. And so, again, I told you projects stop. But sometimes you're wearing people out because of that part-time job that they have. Sometimes you're redistributing capital. Like you have to stop and spend a lot of money fixing the event. And now that money's not in the budget for something else. And usually it's the more innovation that money is getting taken out of. And then sometimes we just see companies get snake bit, right? They just get snake bit. They have something bad happen to them. They never saw that coming before. And it gives them a lack of confidence in what they're doing with technology. And so you see that if people have gotten just absolutely torched from cybersecurity, they're less likely to move quickly with AI. Because in their minds, it's like we went really quickly with our software layer and data layer, look what happened, right? Last thing is just regulatory consequences. This isn't true for everybody as a tax, but if you're highly regulated, then there are many things that can happen to you if you have to announce or if you have to share with regulators or examiners that you've had an event. And that can be everything from you've got to do extra audits because they require you to do that, to terrible things like fines that might be state-based or regulatory fines, to having to burn a bunch of time on reporting, to even just the closer attention that you're going to get, right, for the next couple years because of what happened to you. So, again, I just wanted to go through this. None of this might be necessarily new information to all of you, but I just wanted to try to bring some clarity to, there is a tax, like all of this costs money, effort, attention, right? Market reputation. Like this is a tax on the organization when you do not handle digital risks well. All right, so let's unpack more and more about managing digital risks in that portfolio. Because right now, I've kind of been giving you the impression that digital risks really are just kind of the 5 common ones. But I'm going to show you other digital risks that I don't think that we are managing well, because that's an important part of what I want to get across today, is what is the full portfolio. All right. Obviously, I love using AI tools. They help me create graphics, like the graphics for this deck. But one of the fun things I like to do is say, hey, I need a few quotes that support this content, right, that I wanted to deliver to you. And I don't want quotes from somebody else. I want you to create a quote that is a unique quote based on the ideas that I will be presenting today. When I do a quote like that, I just list it as Scott GPT because I prompted it, but it's a GPT's quote. I love this quote, and this happened to be from ChatGPT. The more invisible the risk, the more loudly it will announce itself. Well, that's a brilliant quote, right? So I thought I would put it on here because that is true. The more invisible the risk, in other words, the more you don't see it as a risk, the more loudly you may start to feel the pain. So let's start unpacking that silent risks or the more invisible risks. Here's what I observe. Boards and leadership teams tend to overfocus on cybersecurity. I get it. Cybersecurity, it's in the news. It can be a devastating type of risk. There's a high amount of taxes that we got to pay. You know, I don't mean real taxes. I mean my risk taxes. And it can be kind of a breathtaking event. Any of you that have suffered through a successful attack, it is breathtaking. It can be shocking. It kind of makes you a little sick to your stomach when it all happens. So the problem is, while we overfocus on that breathtaking one area of risk, we are under-focusing on a lot of other risks, and some of them are costing us money always, like every moment. Yet we're not thinking about them as those kinds of risks. Mark, I see in chat, you should absolutely use that quote. And you can attribute it to me, or you can attribute it to ChatGPT, or you can just say you came up with the Mark. It'd be fine with me. But I love that quote. I'll show you another one a little bit later. So anyway, glad you like it. All right. Here's the first thing I would say when you're looking at a risk portfolio, is you got to be conscious of these 3 things. There are event-based risks, there are operational risks, and then there are strategy risks. Right? Those would be the 3 main categories in digital. And this is an idea worth thinking about, okay? I'm presenting the idea to you, but I want you to think about it more and more at your place, right? Instead of just saying, oh, we have cybersecurity risk and fraud and we got uptime and third party, right? Instead of just saying, oh, we got those. Think about what are the digital risks that you have that are event-based. They will only happen if an event happens or is successful. What are risks that are happening every day, or you may be feeling pain every day because they are operational risks? And then what are the strategy, the decision failures, right, that are the big risks? All right, so there you go. There's 3 categories. Now, let me try to break this down, and we'll talk about those categories again. So I believe that every year there is a risk portfolio that is pretty common across all companies. I believe this portfolio will change from year to year. I don't think it's the same every year. So I want to show you what we believe the risk portfolio is, the most important. These happen to be 10 risks, but I don't care about the number, right? It just happens to be 10. here are the most important 10 risks in the risk portfolio today. In other words, I would say that almost all of you have these same 10 risks, just maybe to a different degree. Now, I believe these break up 5 and 5, and the first 5 are the risks that I've been talking about quite a bit. So what I would look at as traditional digital risks, been around for a while. Cyber, of course, insider issues, which are growing. We've been talking about this for a few years. These are growing. Fraud and financial risk, which I don't really consider to be a cybersecurity risk, right? Digital fraud is a different category. In fact, in a lot of cases, it's different people doing it. All right, business continuity we've had as long as we've had technology, right? This is just, can we keep all of our technology up and running? And then the third party risks that we talked about, right? When you depend on a third party for part of your digital world. So there you go, there's 5 traditional risks. All right, here's where it is much more interesting to me. I'm going to give you 5 growing risks, of which obviously, a couple of these have just jumped onto the risk portfolio in 26, in my opinion. The first one, AI risks. That's a whole update you could do on your own about AI risks, but obviously this is going to grow. These risks are going to go in directions I think a lot of people aren't thinking about necessarily today. We are going to come under regulatory control in some industries around AI and the need to manage AI risks. And let's make sure we're not confusing. I'm not talking about AI governance. AI governance is policy and procedure. I'm talking about how do you manage the everyday risk of depending on things that we call AI today. And I'll talk a bit more about this in a second, but just as an example, things like automation sprawl. I mean, what happens when we actually have built, 500 different automations across the organization, and 200 of those automations talk to each other, right? And they're built by all different parts of the organization, and IT wouldn't even know what some of them are, right? This is what we're talking about, automation sprawl and all the risks that can come with that. Just one example, right? When I say AI risks, there are probably maybe not the same kind of risks people are thinking about, like AI tool being biased or discriminatory. All right, enterprise architecture, and some of these I'm going to talk a lot more about, like these first 3, I think I'm going to talk quite a bit more about, just to give you some more detail, because I want to talk about the taxes on these 3, right? But enterprise architecture risk, I think, is growing, and I think it's on the list for 2026, and I'll tell you why. Enterprise architecture has always been problematic. In other words, the bigger you are, the more pieces of software you have, the more data store you have, the more complexity you have at trying to connect all of your software systems to all of your data systems, right, to have running enterprise architecture. But how we make these decisions, bad decisions, vendor lock, non-connectability, duplicative systems, right? This costs you money every single day. And I would argue that if you're any size at all, that you are suffering from enterprise architecture risk right now that is costing you money right now because of enterprise architecture decisions that you've made. Yet, I don't think this gets managed as a risk. So again, my friends who are CIOs, some of what I'm saying today, I really hope it spurs something in your mind to say, we should start analyzing this. Like, we should start putting numbers on how much money are we hemorrhaging or paying in taxes because of our enterprise architecture decisions. The reason this makes the list now is because of AI, and that there are a lot of decisions that are going to have to be made, architecture decisions over the next year or two, that companies will probably make wrong in some cases, and it'll be hard not to make wrong decisions as fast as it's moving, but there will be taxes that will have to be paid, because people will make bad architecture decisions. All right, digital skills gap. I've been on this hobby horse for a while. So we have a growing gap between the technology that you have in your organizations and people's ability to use it. We know that. I mean, I could say that to almost any leader and they're going to go, yep, you're right. I mean, we've got a bunch of Microsoft tools and half our people have no idea how to use them. But now we have a plethora of AI tools. And then we have a lot of people that don't know how to use these AI tools. And the taxes that we're paying on the digital skills gap, they're every day and they are serious. And so what I mean by that is when we survey, when we do the risk analysis on digital skills gap, we typically find that users are only using 40% of the capabilities that you are already paying for. You are licensing seats and software for people who don't use it because they don't know how. And so you're paying two taxes, the license fee tax that they're not using and the opportunity tax if they did use it. This digital skills gap, again, my friends who are CIOs, who are HR, right? COOs maybe. This is an interesting one to analyze of how much money are you paying in taxes every month because you have a gap in skills that you could erase if you had a much better education program. All right, digital workforce. This is another one that, this year, it's more important than ever, is we're starting to have workforce evolution because of AI. We already had some workforce issues around technology in the past, like digital well-being. But I just read a really good article the other day that talked about the impact of AI on workforce. And it said that it used to be when people were doing things more by hand, there was more of a chance to take a break or take a few minutes and let your mind rest. And that what they're finding a lot of times with employees is AI is concentrating the amount that you can do, and there aren't as many free spaces anymore. And that it's really putting a load on people's prefrontal cortex. And so there's some real concern that, yes, AI can make you much more productive. Yes, AI can do a lot of, or some of your work for you. That doesn't mean you're going to work less. It actually means you're going to be twice or three times as efficient and effective, but you're going to compress the amount of thinking that you have to do and the amount of processing to co-work with AI in a way that actually is pulling more brain power than we've ever pulled to co-work with technology. So we have even more of a digital well-being problem. We have the AI risk of AI taking away parts of people's jobs, the fear of AI, the fear of automation. That's a problem in the workforce. And now we're starting to have an onboarding issue. So everything from, hey, it's hard for younger people to have starter jobs in an organization. You might have heard people talking about the pyramid organization has turned into a diamond, right? Because there's less of those early jobs and that more of what you have to win with your workforce is in the middle now. People that have been with you already for a handful of years. How do we get the most value out of those people? So it's an interesting concept that we're moving from the pyramid to the diamond. But a lot of you who know me know I think it's the circle that we're moving towards. Set all that aside. The onboarding is getting to be more of a problem. Not only because, hey, what are the starter jobs for young people? It's, hey, as we create more complexity in organizations, as we create more automation, as the role of the human being evolves, it's going to get harder and harder for somebody to jump into the game in some ways. All right, so we got workforce risk. That's every day. And then we got digital innovation risk. Now, digital innovation risk is a strategy risk. It's the, are we adopting things like AI too fast, too slow? So let me do this. All of these traditional risks, generally, we can look at these as event-based risks. That's why I put the E there. These are event-based risks. When they happen, there can be an outage. Again, it's a bit breathtaking. It can be expensive trying to do all the cleanup, right, or the repair. But these are event-based risks. Maybe it's why we try to pay more attention to those. I don't know. If you look at these risks that I say are growing and that are costing you money, taxes, every single day, I'd say the top four are operational risks, not event-based, and the last one is a strategy risk. All right, hopefully you're getting an idea right now, a little bit about what I mean about a much more professional way to manage a digital risk portfolio, right? Is say, all right, what are the standard risks that we face? Now, also, by the way, depending on your size, depending on your industry, this might not be the right list for you to start with. It might only be 4 of each of these, or maybe it's you got a couple others. All right, well, let's talk about the couple others for a second, right? But again, this to me, let's just take this list. If I were going to be professional about managing digital risk, because I'm a CIO or I'm a chief risk officer, right? Or even a COO, I want to put together a portfolio like this. I want to risk rate all 10 of these. I want to have mitigation plans for the ones that have the worst risk rating. I want to understand the financial taxes I am paying on these, right? What is the tax I'm paying out of the pocket of the organization? And then I'm going to put that report together, and I'm going to show it to the leadership team, and I'm going to show it to the board. And if you were to do that, that is a highly professional way, I believe, to deal with what we should be dealing with digital risks, is to show a much broader portfolio and put the risk rating and the dollar values or the dollar assumptions on what are the taxes we are paying. All right, let me add one more piece of complexity to this. That is that there are some industry-specific risks. So again, I told you those 10 to me are generic to almost every organization. But I just wanted to show you real quick, and I'll do this fairly quick because I don't want to burn a bunch of time on it. But I just wanted to show you examples. There are some of you that I know are in banking. I saw your names. Okay. If you're in banking, there are specific risks you might add to your portfolio. So if you are a heavy lender, right? Like I saw Russ on here, right? Russ's organization does billions in lending and a chunk of it online. All right. So if you're in banking, then obviously there is a unique risk you face when you're doing a lot of algorithmic lending. Both the opportunity to be defrauded is higher, but also the opportunity to be biased and get sued for turning somebody down for a loan is going to go up and up and up. Once people hear that you can sue somebody for turning you down for a loan, if you can prove that you are in any group, right, that might be shown as you are a targeted group, right, then you're going to start seeing lawsuits show up. So anyway, that's a unique thing to banking, could be the algorithmic risk for lending bias. Another one would be the fraud escalation. So, in the AI world that we're in, it's going to get easier and easier to defraud. And in a world with instant payments, it's going to be hard to pull that fraud back when it happens, right? We try to get better at it with wiring, but we're getting more and more instant payment models where it's going to be hard to pull it back. Like if you get defrauded, there's not going to be any, sorry, hey, I didn't mean that. So that's a unique risk to banks. And then we've got just digital currency, right? If we just talk about crypto, digital currencies, stable coins, things like that, we're going to evolve. Banking's going to evolve where they will care and start to play in some of these digital currencies. And obviously that will be a unique risk for a bank. All right, so John, how effectively can digital skills gap be closed when EA is not yet fully integrated? It's harder, John, because these things are related, right? The tighter, the more useful your enterprise architecture is. You think about access to data and the secure access to data and secure access control models. The better you are at that type of architecture, the more effective you're going to be able to educate people, and the more effective they will be at even wanting to learn. The more barriers there are from the technology and the architecture itself, the more you get a sense of hopelessness from people about, well, why should I even learn that? Like, let's say we give them Power BI, right? And we say, now not only do you have Power BI, you have these AI tools that you can talk to, and they will just talk to the data. Oh, but you can only get to half the data. You get a hopelessness sometimes from users. You're like, yeah, I don't even want to mess with this. Like, there's just too many problems. I gotta wait. I'm going to wait till they get their act together over there in IT, right, or get this architecture in good place. So I think you make a good point that we can close the digital skills gap to a degree, but if you still have a lot of architecture and access issues and data issues, data storage issues, then you really are going to struggle with closing the digital skills gap the way that you could. So great question. All right, let me just give you a few more industries. CPA firms, right? I know there's a few of you from CPA firms that are on here. Obviously, there are specific risks that CPA firms have. especially things like AI assistant professional judgment, right? So you have the issue of a CPA firm that they have to offer professional advice that people depend on. And as they use AI tools more and more, it just increases their professional judgment risk. Or legacy platform entrapment is a big problem with CPA firms, where they are on legacy platforms and it's hard to evolve off those at the firm. So when better platforms come along, that type of, let's say, change management can be really difficult. And so they get into a risk of vendor lock, right? And then there's the client-to-client contagion risk. We've watched this happen at some firms. The firm will send out some information that could be tax information. It might have Social Security numbers, but they'll send it to the wrong client, or the wrong client will get access to a different client's data. It only has to happen once. It only has to happen one specific thing, right? And that can be a serious problem. So anyway, specific things, CPA firms, franchisors, right? We've got a few people here that are from franchisors. They've got brand consistency risk. So if you put out digital tools, or if certain franchisees are using digital tools that other ones aren't, it can lead to very different customer experiences. And you can imagine if, for instance, I get my haircuts at Great Clips. If I go to one Great Clips and it's got capabilities, and then I go to the next Great Clips and it doesn't have any of those, right? It's just not a good look, right? So you have that kind of just customer experience or consistency risk. Digital compliance risk, when I have franchisees all over the country in states that all have different regulations. And then if we don't manage that really well from the franchisor standpoint, we can have franchisees that get sideways with their states. And then the last thing is just the cannibalization risk of, hey, we are doing central marketing campaigns, but it could cut the legs out of a franchisee that's got some specific thing they're doing. Pricing would be a good example, right? If we run something centrally with a price, right, but it's not the pricing model that our local franchisees are using, it can cause all kinds of problems. So anyway, again, I just want you to see the picture that one of the things that's interesting is on top of the 10 risks I showed you, industries specifically have unique risks they got to add to their portfolio. All right, manufacturing, OT. If you're in manufacturing, you know what I'm talking about, right? About operational technology. So you have a whole different set of risks because of the equipment, the intelligence that's being built into robotics, or the intelligence that's being built into your equipment is a unique risk that you would have when you've got OT. As the world moves more and more to digital twin, right, in a manufacturing world, you have risks if the digital twin is not an accurate representation, if it's not a good twin. And then you got supplier dependency. So you got a different type of third-party risk. And so that would be just if your suppliers have events and then can't supply you and you have no backup for that. All right. So Kevin, we saw that. And Jason, we saw that as well. So we'll grab that information and we'll make sure that happens. All right, let me just quickly, I want to go you through a tax breakdown with you, right? So that I told you this concept that all of these risks are a tax on your organization. And I just believe so many of you, your organizations have no idea what the digital risk tax is that you are paying. And so I just wanted to, again, paint a picture for you because, some of you will want a copy of the slides, right? And then I just want you to be able to re-show these slides if it would be helpful to you. But let's talk about the tax breakdown on a few of these, right, that I mentioned. Cybersecurity. In green, you pay this tax up front. This is a defensive tax. So you pay everything that you pay to prevent cyber from happening. That's people, that's equipment, that's vendors, right? That's insurance, cyber insurance. All of that money is a tax on the organization you didn't have to pay 20, 30 years ago. It is the price you pay from getting more and more digital capital. everything in black, we already went through this list, right? But everything in black is a tax you pay if an event happens. And so now it's like cha-ching, 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 cha-ching. All the rest of these kinds of things happen. And again, this is a model that I want you to have that you can use about what is the risk and what is the, what tax are we paying to handle like this one specific area of risk. Again, and we can flip through and look at other ones. It's just kind of interesting. If we said third-party risks aren't really much different. The only thing that I would tell you is in green, you have whatever the preventative costs you have to prevent third-party risk from happening. It could be just the legal fees you pay to put better clauses in contracts with software vendors, right? But whatever you do, especially to the extent that you are investing in having a plan B. Hey, if Salesforce drops out for 2 or 3 weeks, how are we going to do what we do when Salesforce is a key piece of how we do transactions and work with our clients? Just making that one up. So your costs up front on third party, lower than cyber, but they're generally preventative and in whatever money or effort you spend on having backup plans. Then if you have a third party issue, everything else applies. Right now that tax model is the same as a cybersecurity event. All right, but let's change and look at the newer risks, right? So I told you we got these emerging risks. Let's look at how it's a bit different for those. So right now, if I look at AI risk, which is nascent, it's young, it's going to get much, much more problematic, obviously. You have a cost up front in green that is the preventative that you would be doing so far. It may just be hiring consultants, right? It may be hiring an employee, right? But you might be doing a little bit, or you might be doing zero. So you might not be paying any taxes yet to manage your AI risks. But the other thing that could be costing you money is the lessons you're learning, where you are experimenting with AI tools, you're having bad experiences from a security standpoint or anything else. And so, you're paying for this one in either just bad things that could have happened or just the experiments that you're doing. All right, automation failures. We see this a lot with organizations building agents or building AI-driven automations, that you build it, but it's not completely stable yet. But you put it into practice, and then you find out a month later or 2 months later that bad data got into the system and that automation failed. So you're paying a kind of an experimentation tax, right? So those are the taxes you're paying up front with AI risk. And then now the rest of these all apply when you have an AI event, which AI event could be an AI takeover by a threat actor, or it could be just a devastating failure of an AI automated system internally. Okay, again, if we think about a bank making loans, right? And now your automated loan system goes off the rails for whatever reason, right? Now it could be all the rest of these that is the tax that you're paying. All right, again, just looking at some emerging, well, let me finish my thought on AI. So one of the things I really want you to think about is go back to what I said about automation sprawl, right? That as AI integrates more and more into workflows and you have more and more AI automations, and now you got hundreds of them and then thousands of them if you're larger, right? The risk of automation sprawl is one I just want you to keep your eye on, because if you're aware of it now, you'll be better at not letting it happen. All right, the other problem that people foresee with automation sprawl is this black box effect of, hey, no one even understands all of these automations or how they're connected together or how they manage a process. I absolutely can see a day, right? And it's not next year, but I can see it out a few years where that automation sprawl starts to be where we don't even understand how certain parts of automation is even working. All right, then the last thing is just the errors compounding. So if you have one automated system that gets some bad data and goes off the rails, and then it's supplying knowledge to other AI automations, right? You now have an escalating problem, right? Where now you're gonna have to track back to what was the original problem, but I got a whole chunk of our automation that we had to take offline. And would we even have a plan B to be able to replace that automation? So anyway, these are things we just want to make sure you're thinking about when we talk about AI risk. All right, I told you the enterprise architecture risk. This is one that I believe is costing you money every single day. So I believe the taxes you're paying are what we have here in green. I believe every single day you have some level of operational inefficiency. You have some level of wasted resources, time and money. You have some human toll because of that enterprise architecture. You have some reputational damage when customers get to see it, right? When customers can see, or if employee candidates start hearing about it. So, when your architecture is working like the Flintstones instead of the Jetsons, right? That could be a reputational thing. And then of course is the opportunity diversion. Like, hey, if our enterprise architecture was actually clean and working effectively, we would have much more of an ability to take advantage of innovation and opportunities that are in front of us, instead of we're constantly hamstrung by flawed enterprise architecture. So again, in this case, these aren't in black, right? Because they're not based on an event. This is happening to you every day. But do you even know what the tax is you're paying? That would be my interesting question to a lot of you. And so again, I really would encourage you to just consider this one. Like, just consider, well, where have we made bad decisions? Where have we been vendor locked in a way I wish we weren't? Where do we have data that is siloed and we can't access? Yesterday, I gave a talk in Washington, D.C. I was sitting with the chief technology officer, and a question came up in the room before I went up to speak about silos. Like, how do we break down silos? It's a big company. And he said the biggest place they have silos was data, and that they have departments. They had done a lot of mergers and acquisitions. So they have departments, they have acquired companies where the leaders want to they want to silo their data, and they don't want to give anybody else access to their data, which is hurting a lot of their AI work that they could be doing. So anyway, there are so many issues if you step back and think about it, because he and I talked about, well, what's the effect of this? What does this cost you? And he started whipping off all the things that they couldn't do just because of the data silos. All right. I think this is the last one. I just wanted to show you a tax. So the digital skills gap tax, again, I told you, hey, this is a tax you pay every single day. So here's the area of taxes. And again, it's not event-based. This is an operational tax. So every day you have to pay for education. You're spending some amount of money on trying to get people to get more skills. Maybe not nearly enough, but you're spending something. You have the human toll of people that are frustrated, or people that don't know how to use tools, can't even advance in their careers, especially with AI. All right, you have the reputational damage again of there are things that your people do not know how to do with the technology. When I go to an airport and I go to talk to somebody, at the counter, and I ask them to do something that I absolutely know they can do with their software, and then they try to tell me they can't do it. Right? It ruins the reputation of that airline. When I have to argue with somebody and say, well, I know you can do that, and they have to tell me, well, but I don't know how. And I have to go, get me a manager. All right, and then again, the opportunity diversion. If your people were excellent with technology, what could they have accomplished? All right. In this case, this digital skills gap, I just got to point out, like I said, AI is going to make this worse and worse. It's going to make this skills gap bigger. If you're not measuring it, if you have no idea how to quantify what this tax is to your organization every single day, I think if you're a CIO, right, or you're in HR, in some ways, I don't think you're doing everything that you could do, right, in your job. Because this should be a tax that you can analyze and share and say, look, just because we don't have people that are not gaining the skills for whatever reason, either we're not educating them or we're not inspiring them, whatever the reason is, this is costing us money every single day. So anyway, I think it's a crucial one to try to understand and to close. So again, one of my big asks for all of you is just try to sit down and create your own portfolio. right? And it should be some mixture of the basic ones I said, some mixture of some of the new ones that you agree with, right? And then 2 or 3 that are unique to your industry. And then boom, now you have a portfolio. And it should have more than 6 things, right? It should have 10 or 12 areas of digital risk, or I think you're just missing them. And then once you can create the portfolio, you can do some analysis and you can start doing more remediation. All right, I told you I had one other quote that I'm going to Scott GPT the quote. I thought it was really interesting. Every new digital innovation casts a dark shadow. Proactive risk management ensures you have a light to shine. I know I'm going to say something you all already know, but I need to just say it out loud. Managing digital risk proactively, like before you have to pay a bunch of extra taxes, is better than having to pay a bunch of extra taxes later. It's a lot like tax planning in your life. If you do 0 tax planning and you have a good year, you just end up paying a whole bunch of taxes because you weren't willing to put in the work to do some tax planning before you had that really good year. So hopefully, I hope that I'm selling you on the need to be more professional, looking at this digital risk portfolio and doing it up front, spending more time, do more analysis, do more risk rating. All right, I'll just add the last thing. Like, digital risks aren't going to get lower, right? If I just spin through, right, things that are coming, you got quantum, which it might break encryption, right? Everybody acts like they're sure it's going to break encryption. It might break it. We don't know how much encryption it actually will break. This could end up being just a story like the year 2000. What we do know is quantum's going to bring massive power to automation, and what might happen then? Identity risk is going to be more and more of a problem, right? The AI tools creating synthetic identities and being able to steal real identities of people, of companies, all kinds of things. We know that's going to get worse. Lack of AI transparency or the ability to align it with human values. Like, this is still an issue, is we don't have great transparency a lot of times to AI tools, and it may get worse. Where it works, it does magic things. I just can't see how. I just don't understand how. And can I align all of these AI tools to my corporate culture, to my human values, right? Be an interesting area of risk. Personalized AI, that risk is going to grow. The risk of each of us building our own personalized tools, giving it our credit card, letting it go do transactions on our behalf, right? And what that might happen out in the world. More and more AI driving interconnected infrastructure, right? You can't see any problem with that, can you? Right? That AI takes over running more and more infrastructure for cost reasons or whatever, right? But you can just see the problems happen. And then just understanding that now digital risks, they are born and they blow up faster than we've ever seen. It actually took cybersecurity some years to evolve to the danger that it was. I don't think AI risk is going to take that long. Like, AI risks are going to get born and then blow up faster than anything we've seen. So, like, when we think about the future, I like thinking about it this way. It should be a dynamic practice. Every year, you should revisit that portfolio. Every year, you should tune that portfolio and do a little bit more work on how much taxes you're willing to pay, how much risk you're willing to take, right? So every year, it should be a dynamic practice. You shouldn't go to year without investigating that digital risk portfolio. All right, hopefully this has given you some interesting ideas. The next update, right, they're always about 6-8 weeks apart. The next one is going to be all about building your intelligence layer from an architecture standpoint. And honestly, what we're going to do is take it from where are we today to creating the organizational mind. And we've been talking about the organizational mind. We started 2 years ago talking about that in an update, right? And now AI, more and more, it's moving towards we actually can build and architect these organizational minds. So in the next update, we're going to talk more about that. About what does that architecture look like How far along are we at being able to build the organizational mind? All right. Thank you all. Appreciate you again being on live, and the recording will go out. Please share it with anybody you think that this could really be helpful to. Get in touch with us if you want us to help you at all with any of this kind of risk thinking. Thank you.